Corporate finance presentation. Tender offer. Get ready. It's time to take our chance with corporate finance. A tender offer is a public solicitation of all stockholders that they tender their stock for sale at a price specified during a certain time period. So the image we want in our mind, the standard scenario being that we have a target company. It's typically trading. You can imagine them trading on a stock exchange. We then have a set of investors or possibly another company that would like to purchase a significant portion. Generally, a significant portion would like to be purchased of the target company, possibly looking to get a controlling interest, which would be 51% or more of the common stock, that giving them then a controlling interest in it. Therefore, they make a tender offer to the stockholders, of course, being the owners of the company, having the voting power over the company, to make a purchase. Typically, the price that they will be offering will usually be something higher than the current market price to make it an offer that would be an attractive type of offer that the stockholders could then take at a specified time frame. So generally, the tender offers a set price at a price greater than the company's current stock price. So obviously, if you're going to make a tender offer, if you're imagining a set of investors or another company targeting a specific company and possibly wanting to get a significant portion of the stock, possibly a controlling interest, in order to do that, they would have to make an offer to the current stockholders that would be beneficial to them, and that would mean that the price would generally, of course, have to be above the current market price for the tender offer to be effective. If it is a takeover attempt, the tender offer could be conditional on the prospective buyer being able to obtain a certain quantity of shares, possibly an amount sufficient to get a controlling interest. So in other words, if the tender offer is designed to get a controlling interest, which would typically be over 51%, because if they were to get control of over 51%, then they'd have a controlling interest with regards to the voting shares, considering they would generally have a majority of the voting attempts at that point in time. So that's kind of the number that you would be imagining, generally that number or above, if it's going to be some kind of takeover attempt. So if it's a tender offer for that attempt, then you can imagine a situation that if they weren't able to get the number that they wanted, let's say 51%, then maybe they don't want to proceed forward with it. And so they might have the tender offer to be conditional so that they can basically either meet that and then follow through with the offer, or if they don't meet it, then possibly it would not go through. So the tender offer pros, or the benefits of the tender offer: investors are not obligated to buy shares until a set number is tendered, eliminating large upfront cash outlays and preventing investors from liquidating stock positions if the offer fails. So in other words, you can imagine a situation where a set of investors, a corporation, for example, wants to buy a target corporation, would like to get a controlling interest of 51%. So they issue the tender offer. Then the investors are saying, hey, I might want to basically pick up that tender offer. But of course, the investors don't want to pay it unless and until they get that 51%, because if they don't get the 51% or whatever their target is, then possibly they don't want to go through with the tender offer, and that's going to basically allow them to some leeway with regards to the tender offer and how it will function, how it will go forward, rather than putting the large cash outflow up front. So many times investors gain control of the target company in less than a month if the tender offer is accepted by the stockholders. So it can go fairly quickly if the tender offer is accepted. They generally earn more than the normal investments in the stock market. So the tender offer cons: a tender offer can be an expensive way to complete a hostile takeover because investors pay SEC filing fees, attorney fees, and other fees for specialized services. So obviously, to go through with the tender offer and make sure that you have everything set up properly, you got to make sure that you're lined up properly with the SEC, because if it's going through, especially the stock exchanges and whatnot, you got to make sure that the regulations are there, done properly. Attorney fees to set everything up, and other specialized kind of fees to set up a tender offer, which is, of course, something that doesn't happen all the time. And therefore, people that are specialized in those areas to set them up will typically have higher wages or higher fees. So it can also take time because the depository banks need a variety tender shares and issue payments on behalf of the investor. So just to go through the process of issuing the shares and whatnot can take some time as well. If other investors get involved in a hostile takeover, the offer price will increase. So in other words, you could have strategies for the company if the company does not want to be taken over or have a majority interest owned by a hostile takeover type of attempt through a tender offer. One strategy they might have is to go to somebody else to try to purchase the shares of the stock. And in that case, that could push up the price if the company or investors that are targeting the target company still want to meet their objectives. They might have to increase then the price of the tender offer. Avoiding a tender offer. So note that if it is a publicly traded company and the stocks are trading on the stock exchange, of course, the owners of the company, in essence, then are the shareholders. Now, you might have a certain set of shareholders and possibly the management who is hired by the board of directors that is put together by voting from the shareholders that would like to avoid having a tender offer type of situation. It seems somewhat dangerous that you could possibly have some group of investors or another company, in essence, have a tender offer and basically have a hostile kind of takeover, whereas the current management and possibly some of the current board and so on may not want that to take place. So there could take steps to kind of avoid a tender offer from taking place, especially one that would not be wanted, a hostile one. So management can try going to a white knight. So if a tender offer kind of situation had started to take place, then they could try this white knight strategy where a friendly company purchases the target company instead of the unfriendly bidder. So you're basically saying, okay, these people are issuing a tender offer. We are fearful that it might go through. They may be able to get the majority interest, possibly over 51%. We don't see any way to stop them at this point in time. So maybe we're going to say, hey, we're going to go ahead and look for someone else to basically buy us out who we think would be more beneficial to us as the current board, possibly in current management, as opposed to this other group of investors. So this target company still loses independence, but the white knight is more favorable to shareholders and management. So in that case, you're kind of picking the best of two bads, that you're going to say, I'm going to lose the independence because we can't stop the hostile takeover, but possibly we can have some choice as to which companies or set of investors are going to be doing the taking over. So they could move the corporate offices to states with tougher pre-notification and protective provisions regarding takeover bids. So different states will often have different laws with regards to this process, and you could look for a state where it would make it more difficult for a takeover to take place due to more regulations and more notification of the process being going forward with. So they could buy back some of their own shares to restrict the amount of stock available for the takeover as well. Avoiding tender offer protective policies. You could encourage employees to buy stock under the pension plan. So this would be beneficial if you can have an incentive plan for the current employees to invest in their own company. That's one strategy, that you're basically have people that are wanting a vested interest in the company. One, because they are employees, which you would hope that they would just want the company to do well as employees, as they are acting kind of as agents of the company. And two, if they have a financial interest in the company's stock price doing well, as they would if they own stock in it, say in their pension plan, then that's one way that you can support this, because once the stock is in an employee pension plan, it's less likely that they would want to sell the stock in a tender offer, given the fact that they are employees and the fact that selling something out of a pension plan would be a little bit more difficult than selling something if it was just a kind of investment that wasn't under the umbrella of, let's say, a retirement plan. You could increase dividends. You could avoid large cash positions. So large cash positions could be attractive to companies that are looking to target another company who might be looking for more liquidation for their growth purposes. Staggered board of director member elections. We'll talk about this a little bit more, I believe, in a slide, but you could kind of stagger the election process, which could make it a little bit more difficult for the tender offer to basically take control, because obviously once the shareholders have the shares, if they get to the 51%, then to get control or to get the current management out, they're going to have to elect the board of directors. So the board of directors can then vote out the current management system and whatnot and make the changes happen. If you have a staggered board of directors, then they can't do that at one re-election kind of cycle. They got to wait till the whole board of directors kind of cycles around. So you could have a poison pill arrangement as well, which I believe we'll talk about shortly. So a staggered board, that's often used to prevent the hostile takeover. So if a company is worried about a hostile takeover, they might use this staggered board kind of situation. Company only open a portion of their directors' positions to election at one time. So you only have some of the positions for the directors open at one time at some point, and those are the positions that you can vote on for as the shareholders to basically change who has control over who's basically hiring management to make changes in the company. So the staggered board generally has, quote, classes, end quote, of positions, each holding elections in different years. So you got different years as to when you can basically, again, kind of vote out the current board of directors. And obviously, if it's a hostile takeover, you're going to want to vote out the board of directors quickly so that you can basically, change management and whatnot. And so staggered boards are useful for preventing hostile takeovers, but can be a disadvantage to stockholders as well, limiting control. So obviously, that's a good tool to kind of limit this takeover process, but it's also a limitation to making change happen and whatnot, just for normal kind of processes as well. So it could be something that companies will kind of shy away from because in a lot of ways it could be a disadvantage. The same is true with like a poison pill type of option we talked about in a prior section as well. Another kind of defensive mechanism, but one which can result in negative outcomes as well, which could be negative ultimately to shareholders. So defensive tactic utilized by target company to prevent or discourage hostile takeover attempts. The poison pill allows existing stockholders the right to purchase additional shares at a discount, effectively diluting the ownership interest of a new hostile party. So we could have a two-step kind of merger process as well. So if there's not a highly concentrated shareholder base allowing 100% purchase, a two-step merger process can be used. So in other words, if you're looking at this kind of takeover situation, you might have the first offer, the tender offer, once again, looking for that majority interest, something over 51%. And once you get somewhere over a certain number, then again, you have the controlling interest at that point. You kind of have a controlling point, but you still might want to be getting to 100%. And once you have the controlling interest, you have more position, more leeway to try to squeeze out to get to the rest of the 100%. So the first step is a tender offer seeking to get a majority ownership, which would be something typically over 51%. The second step is to get a 100% ownership interest. They would need to get a certain ownership threshold that would legally empower them to squeeze out the minority shareholders. So you got to get the foothold in, get over that 51%, and then get to a point where you have the ability to get the leverage to squeeze out the minority shareholders.